In 1994, a financial advisor named William Bengen published a paper that would change retirement planning forever. His finding was deceptively simple. If a retiree withdrew 4% of their portfolio in year one of retirement and adjusted that amount for inflation each subsequent year, the portfolio had survived every 30-year rolling period in the historical record, including the Great Depression and the 1970s stagflation. 4% became the gold standard. It got simplified into the 25 times your expenses rule. It got baked into every retirement calculator, every advisor's opening conversation, every magazine article on when you can stop working. And then the world changed around it. Not dramatically, not all at once, but in ways that have quietly made the 4% rule less reliable for the retirees of the 2020s and beyond than it was for the investors Bengen studied. And here's what's uncomfortable. Most of the retirement planning industry still teaches the 4% rule as if nothing has changed, which means a generation of people is building a plan around a number that may leave them short. This video is not about scaring you. It's about showing you what the updated evidence says, why the 4% rule needs to be modified for your situation, and specifically what the smartest retirees are doing instead. Because there are strategies that are both more flexible and more defensible than a fixed percentage withdrawal, and knowing them could be the difference between a retirement that lasts and one that runs out at exactly the wrong time. Let's start with the original finding. Bengen's research, later extended by the famous Trinity study, used historical data from U.S. stock and bond markets. It examined what would have happened to portfolios invested roughly 60% in U.S. equities and 40% in bonds, with withdrawals starting at 4% and inflated each year. The result: historically, that portfolio survived 30 years in virtually all scenarios. But notice what the research was based on. U.S. markets specifically, with their historically high long-run returns, bond yields that were materially higher than the near-zero environment that characterized much of the 2010s, a 30-year retirement window, not 35, not 40, and a static 60-40 allocation that doesn't reflect how most modern retirees actually invest. Pull on any one of these threads, and the 4% number shifts. Let's pull the first thread: bond yields. The original research assumed bonds generating returns that offset equity volatility and contributed meaningfully to total portfolio return. In the decade after 2010, bond yields were at historic lows. A 60-40 portfolio with bonds yielding near 1% was fundamentally different from the same portfolio in Bengen's historical data, where bonds often yielded 5, 6, or 7%. Even as yields have risen since 2022, they're still not at the sustained high levels that supported the 4% finding across the full historical period. This structural change in fixed income means the same allocation delivers a lower expected return, which means the same withdrawal rate carries more risk. Thread number 2: longer retirements. Bengen's 30-year window assumed retirement at 65 and death around 95. Today, people retire at 60, 62, even 55. People live longer. A healthy 65-year-old couple has roughly a 50% chance that at least one of them lives to 90. Plan for 90 and you've planned for a 35-year retirement. Plan for your 90s, especially if you have family longevity, and you're looking at 40 years. The research on the 4% rule at 40-year horizons is significantly less encouraging than at 30 years. At 30 years, historical survival rates are excellent. At 40 years, the same portfolio and withdrawal strategy has failed in a meaningful percentage of historical scenarios. Thread number 3: global diversification and recent return expectations. The historical U.S. equity market has generated exceptional long-run returns that are not guaranteed to continue at the same rate. Valuations matter. When price-to-earnings ratios are high, and they were elevated for much of the last decade, subsequent 10-year returns tend to be lower than historical averages. Some of the most respected researchers in retirement finance, including Wade Pfau and Michael Kitzes, have argued that for retirees starting today, a withdrawal rate of 3 to 3.5% is more defensible than 4% when accounting for current valuations and a 40-year horizon. 3% sounds like a small change. It isn't. Going from 4% to 3% means you need to save 33% more before you can retire. On a target of $1 million, the difference is $250,000 in required savings. If that revision is accurate, it's one of the most consequential numbers in personal finance, and most people aren't hearing it. So what do smart retirees actually do instead? 3 approaches have emerged from research and practice that are more flexible, more realistic, and for most people, more psychologically sustainable. The first is the flexible withdrawal approach. The core insight is that the 4% rule fails partly because it's rigid. It asks you to withdraw the same inflation-adjusted amount every year, regardless of what the market is doing. In a down market, you keep withdrawing at the same rate and permanently shrink your recovery. The flexible approach adjusts withdrawals based on portfolio performance. In a good year, you might spend 5% of your portfolio's value. In a bad year, you pull back to 3%. You live on less for a year or two when the market is struggling, and more when it's thriving. This matches how most people actually live anyway. We naturally spend more when we feel wealthy and less when we feel tight. Formalizing that instinct into a spending rule makes portfolios dramatically more resilient. Studies show flexible approaches have significantly higher historical success rates than rigid fixed-dollar withdrawals. The second is the income floor plus upside approach, and it's the one that resonates most with retirees once they understand it. The idea is to separate your essential spending from your discretionary spending and fund them differently. Your essential expenses, housing, food, utilities, insurance, healthcare, get covered by guaranteed income sources that can't be outlasted. Social Security is the primary vehicle, but pensions, if you have one, annuities, or other guaranteed income sources play the same role. These essentials are funded by income that never runs out regardless of market conditions. Your discretionary spending, travel, hobbies, gifts, dining, gets funded from your investment portfolio. Since this isn't survival money, you can be flexible with it. When markets are up, you travel. When they're down, you travel less or differently. This split fundamentally changes the psychology of retirement spending. Retirees on this approach rarely feel broke even in bad markets because the floor is guaranteed. They feel flexible rather than constrained, and portfolios structured this way are more resilient precisely because they're only covering discretionary needs rather than everything. The third approach is Roth conversion and tax arbitrage during the early retirement years. This isn't directly about withdrawal rate, but it dramatically affects how long your money lasts. Here's the idea. Many retirees have the bulk of their assets in tax-deferred accounts, traditional IRAs and 401ks. Every withdrawal from these accounts is taxed as ordinary income. In the years between retirement and age 73, when required minimum distributions begin, you often have an artificially low taxable income, lower than it will be later. This window is a tax planning opportunity. By converting chunks of your traditional IRA to a Roth IRA each year during this window, paying tax at today's lower rates, you reduce the future RMD burden and create a pool of tax-free money. The long-term effect can be dramatic. Retirees who do this systematically over 5 to 10 years in early retirement often reduce their lifetime tax bill by hundreds of thousands of dollars, which is money their portfolio doesn't need to generate. It extends portfolio longevity in a way that rigid withdrawal rate discussions completely miss. What does all of this mean practically? If you're 5 or more years from retirement, aim for a withdrawal rate target of 3 to 3.5% rather than 4%. It's more conservative but far more defensible. If you're already retired and drawing at 4%, implement a flexible withdrawal rule rather than continuing with rigid fixed amounts. In any year where your portfolio drops more than 15% from its previous high, reduce withdrawals by 10 to 20% for that year. In years where the portfolio grows substantially, you can give yourself a bonus. Build an income floor that covers your true essentials from guaranteed sources. Maximize your Social Security delay strategy. Look at what Social Security pays at your break-even age and decide whether delaying makes sense for your health and family situation. And use any gap years between retirement and RMD age as a Roth conversion opportunity. Don't let those low-tax years pass without deliberate planning. The 4% rule is not dead. It's a useful starting point. But it's a starting point, not a final answer, and treating it as one has cost too many retirees the confidence they deserved in the years they could still act on it. The smart retirees aren't using one number. They're using a system. Flexible, tax-aware, structured around guaranteed income floors and adaptable portfolio withdrawals. And that system is dramatically more likely to last as long as they do. There's one more consideration that doesn't get enough attention in the 4% rule debate. The role of your Social Security strategy in allowing you to use a higher portfolio withdrawal rate early and a lower one later. Many retirees who retire at 62 or 63 don't claim Social Security immediately. They wait until 67 or 70 to maximize the benefit. In the bridge years, the portfolio needs to fill the entire income gap. This is the period of highest withdrawal rate risk, because the portfolio is bearing the full load during years when sequence of returns risk is most dangerous. Once Social Security kicks in, the high early rate is a deliberate bridge strategy, not a permanent plan. Modeling this explicitly, rather than using a single withdrawal rate across all 30 years, gives a much more accurate picture of sustainability. The practical implication: if you're in the bridge years between early retirement and Social Security, maintain a larger cash buffer than you otherwise would. The sequence of returns risk is highest when the withdrawal rate is highest. A 3-year cash buffer rather than 2 years during the pre-Social Security years is a reasonable additional defense. One more thing that rarely gets said about the 4% rule debate. Even if your actual return history produces a rate that technically fails, meaning the portfolio hits zero before 30 years, the failure mode rarely looks like suddenly having nothing. What actually happens is that the portfolio declines gradually over several years, giving you clear visual signals that adjustment is needed years before the actual failure point. The retirees who suffer catastrophic failures are the ones who ignore those signals and maintain spending rigidly until the end. The ones who adjust spending when the portfolio shows stress, cutting discretionary spending, picking up part-time income, making a geographic move to reduce expenses, almost always survive the nominal failure scenarios that the models predict. Flexibility isn't just a strategy, it's the final safety net beneath every retirement plan that's built on market returns. Leave a comment with the part of this that surprised you most. If you want the full breakdown on Roth conversion strategy in early retirement, that video is already on this channel. Subscribe. This is exactly what we cover here. One last thought on the psychology of moving away from the 4% rule. The appropriate response to revised research is not anxiety. It's adaptation. The 4% rule failing at longer time horizons isn't a disaster if you know about it and plan accordingly. The disaster is treating it as inviolable truth and organizing your entire retirement around a number that the evidence has moved past. The people who will be most financially damaged by the 4% rule's limitations are those who never heard this video, who built their retirement number on the assumption that 4% is safe forever, at any horizon, regardless of current conditions. You now know that the honest answer is more nuanced. The withdrawal rate that's right for your specific situation, your timeline, your guaranteed income, your flexibility, maybe 3, 3.5, or 4% depending on your specific picture. Figure out which one. Use a system rather than a fixed percentage, and check in annually to see if the system is working. That's the retirement finance approach that actually holds up across the full arc of 20 to 40 years in retirement. A word on the behavioral dimension of moving away from the 4% rule. The hardest part isn't the math. It's accepting that safe in retirement is inherently probabilistic, not certain. No withdrawal rate guarantees that you will not run out of money. What changes with lower withdrawal rates and flexible strategies is the probability distribution of outcomes, moving the worst-case scenarios from portfolio depleted at 80 to portfolio slightly reduced at 92. That shift in probability is worth something. But it requires tolerating the ambiguity of knowing that your plan is likely to work rather than guaranteed to work. Most retirees, with support and clear communication of what the evidence actually says, can live with that ambiguity. What they struggle to live with is the false certainty of believing the 4% rule is ironclad when it isn't. Honest uncertainty, managed with deliberate strategy, is ultimately more comfortable than false certainty that shatters on contact with reality. The strategies in this video give you the former. That's what they're designed to do.